now you had on.
Fantastic, great. So, so perfect, and glad to have you. Fintech is booming, and as I always like to say, you know, Wall Street and banking goes through these cycles, and whenever there's a down period, they just fire as many people as they can, but they still have to offer their services, and they look to fintech, white label products, et cetera, to continue doing that. But there's outside of, you know, servicing Wall Street and the wirehouses, et cetera, fintech is much bigger than just that kind of white label product offering. So there's just so many areas that is expanding into, you know, if you think about all the areas of finance that didn't exist 20 years ago, like whether it's micro lending or lending, private lending markets, et cetera, these things didn't exist. And so, you know, I give the story of Ron Suber all the time, who used to be a prime brokerage managing director at Bear Stearns. And then he and his partner took over Prosper, and Prosper, I think, was making about $5 million a month in loans to their marketplace. And then by the time they left, they were making about $500 million a month in loans a couple of years later. So it's really fantastic what's going on in fintech. We've got some experts speaking here. I've known Gary Saka for many years. He's a Harvard guy, and he's led many of our panels. We are going to make it a point not to be political in this discussion, because we're talking about fintech technology, not about politics. So Gary, I'm going to let you take it away. So thanks so much.
Okay, great. Well, it's hard to not be political, but I'm going to respect the views of all the other people here. You know, this is going to be an interesting panel because we have a little bit of a diverse background. Rick is actually a partner here at Friedman, Mathis and Gray, and he's going to be talking.
Gary.
Pardon me?
Friedman, Mathis, and Gary.
Oh, and Gary.
Yes.
Are you kidding me?
No, like your name.
Oh my God, you make me feel better about you right from the start.
You do not have a monopoly on the name Gary.
Okay, that's fantastic. That's fantastic. Okay, so here's, you know, Rick is going to, I'm going to forget your name. I'm going to call you Gary now. But Rick is going to speak on the different issues of cybersecurity and how to, you know, prevent tremendous amounts of scams and stuff. But I also think when he does speak, it would be interesting for him to, because we come here not only as representing companies, but also as we're individuals. And so it'd be interesting to talk about identity theft, which, you know, I've actually seen people in the Silicon Valley here get quite a lot of money taken from identity theft and trying to recover it. Then we have Sachin. I got to pronounce your name the right name. Sachin Shah, right?
Sachin Shah.
Sachin Shah, that sounds like a great name. And he is COO of 55IP. He's been in investment management and investment tech for a long time, and also been with, you know, a quant hedge fund. So he's going to have lots of things to say.
His friends call him Gary.
Pardon me?
His friends call him Gary.
Oh, he got friends call him Gary. Okay, that's fantastic. Okay. And then Luke Collins, we had a meeting on Friday here talking. He's actually involved in a company called he's business development for Protus LLC, and he's a great guy. He's going to talk about doing the back end work, the plumbing really for alternative investments, try and democratize that. And so this is going to be hard to knit. I think what I'll do, if you don't mind, Rick, I'll have them start on the broader topic, you know, for 5 or 10 minutes each, and then we'll come back to you in terms of some of the cybersecurity, because unfortunately, you know, that's too bad that there's not all honest people in the world. So I think I'll start with Luke, because you have a pretty interesting background here, and you talked about the democratization for the kind of the lower high net worth individuals. So so why don't you define that a bit, and then how
Yeah, of course.
you're trying to fix the plumbing and spread
And
this
you can
market.
call me Gary as well. I don't mind that.
Okay, that's fine. Gary's
It'll be
all around.
Gary. Yeah. So thanks. I appreciate it. And I appreciate being involved in this, Marty. And Proteus is a financial technology firm. Although I am based in Boston, our firm is actually based out in Indianapolis. And the history is important, particularly relevant, I think, to this conference, because we were for many years an operating division within a much larger technology firm that some of you, particularly those of you in the family office space, may be familiar with, called Archway Technologies. Archway still exists, but it's now an operating division within SCI, the large financial services firm out of Philadelphia. And Archway is a dominant provider of family office accounting, general ledger, and data aggregation services. And we were an operating division within there. We lifted out about 3 years ago. We're now an independent firm. And our technology, as you said, is really focused on democratizing access to alternative investments that are issued in the form of limited partnerships, 3C1, 3C7. So it's really the range of alternatives. It could be real estate infrastructure, private credit, hedge funds, again, anything in a 3C1 or 3C7. And it's really the very sophisticated partnership accounting technology that we developed when we were part of Archway that allows us in a way that is compliant with all the both regulatory and accounting rules to allow private wealth advisors to allocate to these private funds in a way that really is, as you mentioned, really offloads a lot of the plumbing and administrative work, the paperwork, the subscription process, as well as the analytical and due diligence process. So that's the space we're focused on, and in particular able to offer a little bit in the weeds here, but able to offer access down to what's called the accredited investor level, not just a qualified purchaser level. So down to, it's not a retail offering, but down to investors with as little as 1 to 5 million in investable assets. And as you have probably read, it's a fairly active part of the financial services and fintech space. That's sort of the Proteus background, and it's certainly an area where we're seeing a lot of interest on the part of these independent advisors. It is an enterprise solution, so it's designed to plug into these independent advisors and their portfolio accounting and custodial systems, but we're seeing a lot of interest on their part.
So let me ask you one that there's the SPACs that are coming in, the special asset acquisition corporations, special purpose acquisition corporations. They come public at $10. Tortoise is doing its #2 offering, and it has a warrant, a fraction of a warrant, usually at around $11.50. And it seems like for a person who might even be below the 1 to 5 million, or even others, that you could go and buy something like that. If you don't like the acquisition that happens, a few months to maybe up to a year later, you can cash out at the $10 initial offering price plus interest. So usually you'll get, $25 and a quarter or so. Meanwhile, there's some options on these, so maybe you can write out of the money options, call options, and actually lower your costs below that. So are these things going to compete with the dollars for these qualifying investors, or the small?
I think they might be. I have
just one other thing.
Yeah, go ahead.
So
yeah.
Go ahead. You go ahead.
Yeah, I have to admit I am a salesperson, so I am obviously an expert on all topics, although that is one topic I'm not particularly expert on. I suspect that it will, just as registered 40 Act alternative products in a sense compete in our space. But I have to be honest, other than being aware of SPACs and kind of the way you describe them, they're not really a part of our world, and I wouldn't say that we see them as a big area of competition right now for us, but it's certainly another area where we do see activity.
Yeah. So one thing, I'm in a public company, a transportation leasing company. We're just going and taking asset-backed securitization issues that we issued one at just under 250 basis points, almost 150 basis points less than the prior offering, actually making the company, if you do the numbers, it's 75 cents more a share next year once you write off the fees in this next quarter. And so the people that are buying them are mostly insurance companies, and that's a pretty skinny yield to get for 5 years, 2.25. So what happens to all these people? So low interest rates are good for the government, when you get down to it, because their interest expense is going to continue to go down as they keep refinancing. But for people that are like writing insurance companies who are writing life insurance policies or fixed annuities, those guys, they're not going to earn enough money, so those
Right.
rates are going to have to go up. So those guys are heavily regulated. So do you see opportunities to try and get into a broader market there where they're regulated, so that these people can earn some yield, or do you think that these products are going to be inherently too dangerous based on their very heavily regulated nature?
Well, again, that regulated part of the market is not, we're really focused on the private wealth intermediary channels. And I think for us, our technology right now is sort of predicated on the US regulatory environment. That is the SEC and FINRA. We're looking at opportunities in Canada and the UK where there are different regulatory regimes, but they're somewhat analogous to ours, and the rule of law is somewhat similar, although the rules are different. They're not dramatically different, and we think our code can be rewritten to accommodate those. But yeah, in those regulated markets, I mean, the only thing I can say is that we certainly see as well in the private wealth a tremendous interest in any kind of securities or strategies that generate yield. And, all the risks that go with that people aren't always completely understanding what they're investing in, what the underlying securities are. And that's where, as an enterprise solution, we really try to work closely with these advisory firms to make sure they're being diligent and appropriate with their clients as far as educating them.
Okay, well, that's great. So let's go on to Sachin, and maybe you can take off on those and tell us a little bit about your firm and also what you see happening in the wealth management market.
Yeah, so thank you, Gary, and Marty for the invitation to speak here today. It looks like we have a good audience here of advisors and vendors and family offices. I spent most of my career, 21 years, in really the convergence between investment management and investment technology. I would say 3/4 of that time was really spent in the alternative space, and hence my longstanding relationship with Marty and some of you as well. And the past 4 years, I've really moved my experience to the retail wealth management space, which has been a fascinating journey for me individually. But there's a lot happening there, right? And it's been a very exciting time in wealth management as the markets and the way that investors are approaching markets is rapidly moving, rapidly changing. And so a lot of what we were talking about on this conference today is really on the alternative side of the asset allocation pie, which is great for me to hear because I've been away from it for a while. What I want to talk to you a little bit about today is really on your liquid beta exposures that are in that asset allocation pie, and what's sort of trends are happening and how investment advisors or family offices are really approaching that. So, one major thing that I would say has been happening is really around this move to model-based portfolios. And we're seeing that, widespread adoption of models, primarily ETF and mutual fund-based models. And then for certain types of clients and investors, incorporate single stocks. And, one day, and I want to talk to Luke about this actually at some point, about bringing alternatives into the model-based portfolios to really filling out that asset allocation pie, and doing that in a way that's very efficient and clean for the end investor, whether it be the family office or an individual. But this massive shift to models is happening, right? The train is left the building. $3 trillion are in model-based portfolios today, according to Broadridge report last week. I mean, the entire wealth management industry is 20 trillion across 300,000 advisors. So a big chunk of that is in model-based portfolios for the liquid sleeve. And so why is that happening? Well, you know, it's really hard to beat the market, and particularly after 10 years of bull market, you know, and I think advisors and the clients, I think the clients are really asking for, you know, let me try to get my alpha in places where we know that we can get uncorrelated returns and we can actually generate some return. But in terms of the market exposure, let's really, you know, let's focus on things we can control, like taxes, which I'll come back to as it relates to 55. And you, Mr. Advisor or Wealth Manager, I would love to really you focus your time on my financial plan, on making sure I meet my goals, on my lifestyle goals, and I want you to service the hell out of me, right? And make my experience with you as my wealth manager really good. And to do that, we all know that takes a lot of time. And so to do that, you know, advisors are moving their practices to the model-based ecosystem. Now, the issue that is becoming more and more apparent is that there are some frictions to move portfolios into new portfolios, right? And there are a lot of reasons that we have this sort of money in motion. In wealth management, there's this concept of money in motion, you know, as the industry moves from commission-based portfolios to fee-based portfolios, or our clients move from one advisor to another advisor, many of us are moving from accumulation phase to decumulation phase in your retirement savings. And so, you know, in all those cases, there's tons of, you know, there's a specific friction that gets in the way every single time, and that's taxes. And so, you know, at 55, as it relates to 55, our platform, we call it a model adoption platform. And it's really been built to really drive flows to help advisors get their clients into the appropriate model portfolios that makes sense from a risk standpoint, but do that in a way that's super tax efficient. So we call it tax smart implementation of these model portfolios. And so we've had a fair amount of success in the recent time as a fintech company, delivering this solution to family offices, to investment advisors, on independent RIAs, on broker dealers, and now even the wirehouses, by unlocking this demand of going from getting clients into the right size portfolios that make sense for their investment horizon.
Hey, Sachin, I've got a question for you before we go any further. So, you know, we've talked about wealth management in the past in other conferences. It seems like wealth management has changed a lot. And one of the things I've heard is that wirehouses are spending a lot less money on the training for wealth managers. You know, acceptance of new technology is not so easy. You know, ultimately there'll be fewer wealth managers. So fintech has to replace some of that. You know, can you just talk about that, the marketplace for wealth managers as well?
Absolutely. So all of that is spot on, Marty, right? So obviously there's pressure on fees. And so that brings down, you know, the ability for wirehouses to have a lot of financial advisors. So you're seeing consolidation. It makes it difficult for asset managers to have, you know, tons and tons of salespeople to sell the financial products. So everyone is sort of getting squeezed. And that's another reason why all wealth management in general is trying to create these efficiencies in their practice. And so by moving into model portfolios to sell a package of ETFs as opposed to ETF individually is a good way asset managers can save money. Consolidation of advisors supplemented with fintech is a good way the wealth management platforms can save money, right? But what can't get lost, right, what can't get lost is the investor's experience. And so what, you know, robo-advisors came on the scene, you know, I don't know, now 5-10 years ago, and they've essentially failed. Robo-advisory in the traditional version 1 has failed, right? Because their whole plan of replacing the advisor, well, that's not going to work either, because the experience becomes, you know, definitely inferior to what it needs to be for all of us when we want to go talk to our financial advisor. So it's this hybrid version of digital a digital sort of adoption, right, with this human interaction is ultimately the model that's coming forward. And at 55, we are really we're in a place where we're augmenting the financial advisor or the multifamily office in their delivery of investment service in a tax smart, efficient way, in a way that makes sense for their clients. So hopefully, Marty, that answers your question.
Great, yeah, keep on going.
So, in order to get everybody in this, Rick, you've been waiting patiently here. You're going to talk about cybersecurity, but I think that you can start off with, you've listened to two of our panelists already. Do you see anything that when people are investing in these other intermediaries that the people should be watching out for, and then you can drill down to more specific cybersecurity issues?
Well, yeah, I've been doing technology exposure since 1998 and privacy since 2003. So I've watched the evolution of this space over the last 20 years. I had hair when I actually started doing this.
Well, so did I. We all had hair. Go
Yeah.
ahead.
Yeah. Someday ask me to send you my favorite picture from 1978. You'll never recognize me. So I think the key word is due diligence, or the key term is due diligence, because when you invest individually or as an entity, you need to do your home entity into which you're investing. And the landscape has changed. Back in the day, you worried about throwing paper out. You worried about rogue employees, things like that. But we are not living in a tangible universe anymore. We live in an intangible universe, which then gives the world at large access to all of your data, your information, your personal information, your business trade secrets, patents, things like that. So we need to segregate the different constituencies. The first constituency, as you say, are individual investors, and into what vehicle are they investing, and how secure is the data that that entity is possessing. There's also the technology element of that. For example, maybe you don't hold third-party personal information, but you may be the backroom operations for another entity, and if you crash, then everybody who uses your services crashes. Like we had that with Zoom recently. We had that, I believe, with AT&T recently. The technology sector is under duress and will continue to be under duress. And as people telecommute more, not just the technology sector, but all sectors that use virtual networks are going to be under attack and are under attack. I think I read the other day that ransomware and business email compromise attacks are up, I think, 95% since the advent of COVID, because it's an easy target. The second constituency, besides the technology companies or besides the individuals, are the technology companies. So the technology companies are an easy target. What getting in may not be as easy, depending on the nature of the security and the nature of the systems in place and the nature of the human factors training. And I would like to put a fine point on human factors, because I'm going to come back to that. But the vast majority of matters that I've seen are people just making mistakes. Innocent mistakes, sometimes not so innocent mistakes, like rogue employees or disgruntled employees. But intelligent people do unintelligent things sometimes, and unintelligent people, I won't even say what they do because I don't want to get into that. But so everyone is a vector. Every human being is a vector, not just your technology, but you yourselves. And the third area are the companies that hold or lay off third parties' personal information. So they may not be a technology company. They may be a bank. They may be a hospital. They may be an accounting firm. They may be a law firm. In every professional sector, every retail sector, every financial sector is under extreme duress. And we're seeing the advent of more robust, stringent regulatory compliance obligations. Like, for example, the financial sector is susceptible to the New York Division of Financial Services regulations, which require certain companies in the financial sector to abide by the regulations, including human factors training people not to do stupid things. We have the California regulation CCPA that I'll venture to say is going to become legislation. There's a ballot initiative here in California on November 3rd that will bring California's regulations more in line with what we see in Europe under the GDPR. And then we have the New York Shield Act regulations. Again, all of these are compliance. They're not voluntary compliance. They're not, you do what you want to do. They are mandatory compliance. And if you are out of compliance, for example, you don't train your employees who interact with the public at large or have access to public information, you could be fined astronomical sums. I mean, in the 7 figures, 8 figure range. So, you know, it's a holistic approach. But from an individual investor standpoint, don't just throw money into a fintech because it sounds good. The business model sounds good. You need to know that what you're investing in is a viable operation, that one mistake isn't going to be a bet the company kind of mistake. I've seen statistics that say 60% of companies that have been breached go bankrupt. Small companies go bankrupt because they lose their reputation, they lose their trust, and there's just so much competition out there in every sector that, you know, fool me once, shame on you, fool me twice, shame on me. So with that as a background, I want to say in the phishing area, and I don't know if people know what phishing is, but just to give you a paradigm, you get an email from some random person saying, click on this link, you need to plug your credentials into this link, we're AT&T, we're a bank, we're whatever. But it does not take you to the legitimate site that you think you're going to. It takes you to a site that is owned and operated by a fraudster. And if you then sign in, you've now given them your login credentials for that, whatever company it is, a bank, for example. You know, I've seen, and we can get to social engineering, I don't know if we have enough time, but you get an email, say, from your boss, you get an email from a vendor, you get an email from a customer saying, wire money here. And you don't vet it, and I can talk a little bit about how you might vet it, and you just execute the transaction. I had one claim where a third party was sitting on $25 million of client funds. And somebody in accounting got an email saying, wire the money here, and did not do their homework and wired the money here. And it was to a fraudulent bank in Texas, which then the money went to Mexico. And then, you know, it's been around the world 57 times. And it was $25 million of client funds that was uninsured. So that was a $25 million net hit to that company. Now that company was able to survive, but how many companies can lose $25 million uninsured and stay in business? Not just from a client standpoint, from an operational standpoint. You know, you're out $25 million. Who's got that sitting around? Maybe you do, Gary, but most of us don't.
So let me ask you, Rick, in terms of that, do you see most of these really being clicking on that link in the phishing, or do you see that some people might actually recruit somebody inside, give them a little payoff?
That's called enticed. That's called enticed. So a third party malfeasant entices, put that in quotes, an employee to do something with the advantage of a reward being given to them or some financial benefit being given to them. And they may not be a rogue employee, they may be the best employee in the world, but you know, they see dollar signs and all of a sudden their eyes light up. You may get an email, and this is now social engineering and business email compromise. This is not phishing. You may get an email from your boss saying wire money. You may get an email from whomever credible that looks like it's from the person who it purports to be from, but it's not. Like if there's an I in the person's name, maybe it'll substitute an L. You can't tell the difference. You need to always look at the originator of the email, because it may not be from the person it says it's from. We had that here at Freeman Mathis and Gary the other day. Somebody went on a social engineering expedition within the firm, you know, and our attorneys are very, very well trained, and there was no harm, no foul. But training is mandatory, not only under the regulations, but for survival of the fittest. So, you know, I give courses in this at least a day, sometimes a 2-day course. So we're synthesizing, you know, 15, 16 hours worth of information into 5 minutes, 10 minutes.
Yeah.
And the thing too, Rick, I'd say just from as a user, the sophistication of these things has increased like multifold. In other words, they used to look pretty goofy and it was pretty easy to figure out, but they have gotten really, really good. I mean, you really have to look at them to make sure that, you know, it's not legitimate. So
yeah, it's a game of cat and mouse. You know, you don't know what the bad guys are going to do, not in a novel type of attack, until they do it, because you can't predict what somebody's going to do. You don't know what's in their head, but they can find a weakness, they can find some kind of flaw in the system and get in. So once they do what they do, we now know what the vector looks like and fix it. So then they move on to the next new vector, and you fix that, and then they move on to the next new vector. You know, and I'll get to an example of, I'm going to talk about vendors a little bit, but you know, I worked on Target, I worked on Home Depot, and those were both intrusions via vendor portals. In one case, it was an HVAC company. In another case, it was the vendor, another vendor, and they would submit their invoices through the vendor portal. They now have access to your infrastructure. Well, someone gets into the small HVAC company, someone gets into somebody's system, and they steal their credentials. And so now they have credentials to log into, let's say, Target's systems. They're now in. Now everything is segmented off. So there's a bubble wrap around every single different compartment of the system. But once they're in the vendor portal, they can worm their way out of the vendor portal. And now they're out and they're in the wild, wild west. Now where do they go? Well, in the case of Home Depot and Target, they attacked the credit card portal, the PCI portal. So they went in and they stole all the credit card information. So, you know, I would say beyond employees, which are a huge risk, third parties with access to your systems are a horrible risk. And, you know, it brings me to one of the colloquialisms: you're only as strong as your weakest link. And if your weakest link is a vendor who has access to your technology and your infrastructure, well, away we go. You know, and in the case of small companies, you know, they typically do not have as robust cybersecurity as the big companies. You know, the big companies do training, they have all the capital to invest. Whether they invest appropriately is one thing, but they've got the capital to invest. Smaller companies can use off-the-shelf security, or maybe they have an IT person who is somewhat sophisticated, but not as sophisticated as the bad guys. So just by analogy, if you're going to rob a bank, are you going to rob a bank in Manhattan, or are you going to go somewhere up in Westchester in Sleepy Hollow and rob a bank on a corner in Sleepy Hollow? So there are thousands and millions of little banks like Sleepy Hollow. So you could spend 2 or 3 years trying to get into Bank of America, or you could spend 5 minutes trying to get into 1,000 small companies. And, you know, the return on investment is much greater with small companies. So, you know, again, if companies want to put their head in the sand and say it's not going to happen to me, I'll repeat, 72% of small companies were the victims of ransomware. And I can talk about ransomware from now until the cows come home. Only 28% were medium-sized companies. Why is that? Because small companies are easy. So just to give you a little bit about ransomware, you know, someone at your company does something stupid, and they enable a threat actor to get into maybe their workstation. And that's been the historical approach. They get into the workstation, they lock the workstation. All right, so maybe you don't have access to that computer, maybe all your data is stored on that computer, you've got to pay. Well, in 2016, 2017, we saw NotPetya, Petya, WannaCry, which are different strands of ransomware. And there's at least one strand a day being invented and deployed. But in these cases of the new versions of ransomware, they don't just lie on your workstation. Again, they can worm their way out through your entire network and your network infrastructure and shut the whole thing down. And one thing that really annoys me is everybody says they have backup. Okay, great, you have backup. But the backup is attached to your same network infrastructure. So when they shut down your network, they shut down your network. So you need to have your backup in a completely different server. And it doesn't have to physically be in a different city, but it's a different server. So if they get into server 1, everything's backed up on server 2. And I will tell you, data restoration, if you lose all that and you don't pay the bad guys, or you pay them and they come back and do it again, the cost of trying to restore that data can be astronomical. It's more than lawyers, it's more than IT forensics, it's more than the ransomware amount. It's just off the rails, and people don't talk about data restoration. Now,
so Rick, for the other panelists, I mean, and maybe because you've got a very interesting topic, I guess maybe you can, if we let Luke and Sachin talk a little bit about how do they vet and protect their data, their background, because lots of companies go in there and they're depending on them to do the back end. So maybe what I'll do is have Luke talk about how does he vet the people and make sure the data that he's working is secure, and then we'll do Sachin, and then you can give some comments on that. In terms of that.
Luke or Sachin, if you could talk about like white label employees.
Absolutely, yeah.
The trend that we're moving towards.
No, and Rick, I think your point, I remember the story, this isn't my area, but I remember the story about Target and the other, these sort of vendor intrusions. And for us as a platform, in addition to our due diligence of the managers and strategies that we make available on our platform, of which a significantly increasing component is us analyzing and measuring their own cybersecurity policies and procedures, it becomes even more important for us because they are connecting to us and providing us with stuff as mundane as quarterly investment letters and so forth. But we know that our system then is interfacing with private wealth advisors, portfolio accounting, and custodial systems. So there's a multi-level concern, and it's a big part of what we do as a management team, but as our technology people do as well, and I'm sure for Sachin as well.
Yeah. So
if I could,
go ahead.
If I could just one thing, just as a follow up to what you said, if you get that newsletter and you open it, it could be a virus, right. And then you deploy the virus into the system simply by opening the attachment. So it's not only going to fraudulent websites, but it's deploying
the stuff that's embedded. Absolutely. Yep. No, it's as you said, it's whack-a-mole. It's just become a big part of our business. Sorry, Sachin, go ahead.
Yeah, no, thank you. So, look, at the end of the day, we are, we're talking about fintech, right? And ways we create efficiencies in business, but do that in a way that's obviously secure. Our data, we're talking about end client data. Our whole business, the whole financial business is based on client data. And so we take at 55, we obviously take this very seriously. We also have our clients, our enterprise partners, our BlackRocks and JP Morgans and very large firms. So we are SOC 2, we're getting our SOC 2 compliance, and we do penetration testing, and we do the whole slew of items that we need to do in order to secure our client data very, very strongly. I think that how as it relates to wealth management, it's a very, it's a very important issue, and unfortunately also a very costly issue, which is sort of driving some of the trends, right? We are a well-funded company that can afford and will need to invest in these types of capabilities in order to meet the demands of our clients and partners. However, I would argue that it's another driver. Compliance and security is another huge driver of why we're seeing consolidation in the advisor marketplace, right? Because it's just too costly to run a company that has, I deal with financial advisors every day, and there are, believe me, that there are firms, independent firms that are, the proverbial two-man in a Bloomberg, and there are obviously multi-gazillion dollar, billion-dollar firms that have all the bells and whistles. It's not going to stay that way, right? It's going to have to consolidate to meet the standards that Richard is talking about, in order to meet the needs that we have for our clients. And so, there are a lot of drivers and trends and what's changing the investment landscape, meeting the regulatory needs, being the security needs, fintech, innovation. All these are aspects that are driving what I think will be the new way of money management in the years to come.
Yeah, and the exposures for fintech are even greater than perhaps retail, because you're, first of all, you're holding information from a multitude of companies.
Right.
And so let's say that you are breached, like there was a telephone company that recently got breached, not AT&T. And so all of that data from all of those people are out there. Now, maybe third parties lay off their information to that company. So those third parties whose information the fintech company is holding may get sued by their consumers or whomever. They may get sued by regulators. Well, if it all relates back to the fintech company, then the fintech company is going to get sued perhaps by a regulator, certainly by their clients. And so you're going to aggregate the clients and the clients of the clients, and the clients are going to present you with a bill, not only for your own their own expenses, but their clients' expenses.
Right, and I'm sure Sachin has seen this too. It has uncorrelated to the size of the firm. You just saw this story recently where Citibank made a mistake and cut a wire to in some lender. They forgave some loan to somebody with whom they were in litigation, and that was the case where it was just a mistake. It wasn't fraud. It wasn't, but it was Citibank, for goodness sake, So it just because it's a big firm, as you know, like Target, just because it's a big firm doesn't mean that they have all the controls in place. So,
and it can grow exponentially.
Sachin and Luke, can I ask a question? I just want to jump in here for a second.
Yeah.
Can you guys talk about the architecture of where your data sits? I mean, if you have data that encompasses multiple countries, multiple companies, is it all in the cloud? Are there multiple instances of the data? How is it firewalled? How is it protected? Does it all just come on Amazon? Is it like plug and play?
That's a straightforward one for me. We have institutional grade infrastructure as it relates to our data. We have offices in Boston, here in Boston, as well as in India. It all sits on the cloud. It has redundant locations. It has all sorts of firewalls and security measures in order to meet the U.S. standards for security measers. Like I mentioned earlier.
Do you administer the data from India, or do you administer it from the U.S.?
We administer from the U.S., but we access it from various places. So,
and that introduces a whole nother concept that I wasn't going to get into, but if you store data or hold data of, let's say, Europeans, now you're susceptible to the GDPR regulation, which is the most robust data privacy regulation in the world. And so if you're transferring data between the US and the EU, for example, you have to worry about that. And recently, the European Court declared what we call the privacy shield illegal. And so you no longer have the protection of the privacy shield to the extent you're transferring data from US to Europe or European resident data.
So Sachin, how do you handle things like that? Rick, sorry, Sachin, Europe?
Yeah, so we're not in Europe at the moment, so I
Okay.
can't speak to that specifically. I just have I have an operational technical team that's based in India that is more like my offshore team, right? We don't have clients or data that's coming out of
My
Europe.
assumption is that development is in India, but not production.
Correct, exactly, right? And
And Luke,
business.
is that the same case?
Yeah,
with you?
that's a big reason to be candid. That's a big reason why we're likely to, we don't currently do business in Canada or in the UK, but that's a big reason why we're more likely to go to Canada first. It's a smaller market, but that all those privacy regulations are just, they're not unreasonable, they're just incredibly complicated, for much more so for us to deal with than the Canadian private wealth market. I think will probably be our next entry point versus.
I mean, we know people that are part of the regulatory environment in Europe. We've had them speak to our group.
It's crazy.
And, you know, their consideration is that these are not European companies, that they really, you know, there's no favoritism towards them. So they want to regulate, you know, non-European companies, right? Because there's a competitive aspect to it.
Let me give you an example. I'm working on a case now where a U.S. company experienced a breach and it affected EU residents, and the commissioner's office in the UK preliminarily fined the US company £100 million. That's real dollars, that's sterling. That may not be the final fine, but that was where the starting point was, £100 million. So, you know, these people are taking this seriously. And, you know, one little political comment, Gary, I'm going to throw one your way.
Okay, you can have one. I had one last time.
Regulators no longer are capitalized necessarily by state and federal governments. So they've got to be self-sustaining. How do you self-sustain? You find an incident, you find the company, and then you're bringing more money into the Commonwealth or the state or the federal government than tax dollars. So, you know, these people are keen to keep their jobs, maybe get raises, maybe get bonuses. And so they are very, very keen on bringing revenue into the regulatory environment. So, you know,
Everybody wants to be a revenue center and not a cost center.
That's right. That's right.
It's an old saying in the banking world. So,
Yeah.
like the
So Marty,
post office.
we actually have one. We actually have one in the chat. I was just looking at the chat, and I think this might be of value to a lot of people too.
Go ahead.
And it turns out that they said we'd like to hear the role of digital financial market infrastructure, specifically disrupting all industrial value chains.
What does
And
that
so
mean?
what they're saying is, before you used to know
that like
the people
crypto
you
or
bought from,
blockchain?
now you're just you're buying from all over the place. Isn't this an issue? And well, you know, not only Amazon, you know, I mean, I bought some masks, and it turns out they weren't got them 6 weeks later or something like that.
But I mean, are we talking about blockchain?
We're talking about basically people moving away from direct contact in terms of buying their products in the industrial value chain and using everything in digital, maybe with intermediaries, which could also have an issue with, you know, how do you trust those people to deliver the products that they will, or that could also be a scam.
But we're talking about blockchain, right?
Yeah,
Like that. I mean, some kind of digital marketplace, right? My perspective is that it's very difficult to have a trusted network. I mean, I think it's been shown with all these violations of the blockchain space and crypto space that there's failures everywhere. I mean, they still haven't found that guy in Canada who mysteriously died. Where's the body? I think they found the tooth, right? So I'm not gonna. I don't think that's something worthwhile to talk about. We've really gone through.
Okay, no, that's fine. That's fine.
Ad nauseum in our group, and I think one of the issues is that if there isn't a country behind the system of trade, then I mean that's your trust, right? You can tax. The country has ultimate taxing authority, and so So if there isn't a country behind it, who's going to build that system of trust, right? So I find it impossible. You know, it's a kind of like a dream. The longer I've been in it, the more I think it's a dream and not necessarily something that's going to be happening. Because I've seen a lot of it. I think Bitcoin was great. It's been a great run, but in terms of blockchain, I just don't. I think if there's a part, it matters from an infrastructure point of view. But in terms of replacing any system, I don't think that's going to happen. Why would anybody want to have like a
one of the problems is that historically companies have, with limited assets, are investing in their core business, and they are doing that to the detriment of their operations. And operational exposures like cyber are really where I think the greatest liability exposures and risk exposures are. And companies just aren't, or don't have the capital, or whatever, are not investing in the operational things. And that's why these regulators are forcing them to do that, kicking and screaming.
Oh yeah. And having been in the software business many years ago, I think there's a lot of stuff that's kind of swept under the carpet in terms of vulnerabilities and in terms of quality of product development. As you said, the regulators are forcing them to do stuff they should have done in the first place.
Right. Let me give you just one real world example for a small company. Let's say you lease your copy machines, which most companies do. Well, there was a company that leased a copy machine. Well, now we know the copy machines scan the documents and store them on the hard drive in the copy machine. So it's now on the machine. Well, let's say you return the leased copy machine to the lessor. Well, in one case, a company returned their copy machine to the lessor. The lessor then released the copy machine, that's released the copy machine to CBS. It was then put into operations at 60 minutes. 60 minutes went into the copy machine that they were using, and they found all the stored data from the prior lessee because it had not been wiped. And people don't think about wiping a hard drive on a copy machine. I mean, who thinks?
Right. So what's the process exactly? Yeah. I mean, very straightforward, very simple, right? I have to end up because we have to move to the next panel. But this has been a great discussion, and I want to thank you guys so much. So thank you.
Thank you.
But before we
very
go, I would like to say this: at the end of each of our meetings, board meetings, we grade the people. So I'm going to give a grade first
look
of
at
all
that.
to Luke, to Sachin, and Richard. Wait. I'm going to give him an.
We all get
Rick,
an
I'm going
A?
to give you an A also. So we all
Wow.
get an A for that one.
That's my
Sounds
kind of
great.
class.
Gary, is this
Thank you,
grade
guys.
inflation? Because
It's
I
great.
hear that at Harvard these days, the average grade point average is like 3.99.
Yeah.
Yeah.
My dad always told me that a gentleman's grade was a C, and so I told him when I came home for my first year in college, "You've raised a real gentleman, Dad."
Yeah, that's right.
Thank
Well,
you
that
very
was
much.
great, guys. Thanks.
And thank you, Marty.
Fantastic. Listen, great. So we're going to talk about RIA, broker-dealer, and other financial service and banking issues. And Mike Berwick's going to be leading that discussion. So, Michael?
Thanks, Marty. I really enjoyed the last panel very much, and I was concerned a little bit at the end that Gary's going to be issuing grades for the other panels today as well. So hopefully that's not going to happen.